right, good morning, people. So, several of you have asked me about filling in weekly payments, and then some people asked me if I could actually track and report on um, the Roundhill weeklies. I've been gathering data, so I'm going to take you through everything in a deeper dive here than I've done in the past so you can understand it. So let's start with the Roundhill website, and then I'll do some spreadsheets. Although I'm getting better, I think, at presenting them where they really don't even take the look on of a spreadsheet because sometimes spreadsheets just limit you on how you can present the data. But I've kind of figured a way to overcome that. So when we go in here today for these particular weeklies, there's two funds. There's XDTE and there's 0DTE. So what are these? Well, first off, they're covered call strategy. And see the keyword there, strategy? So they don't really own the S&P 500 shares. So a strategy just means they have a synthetic, or in this case, they just really go long and they own a call on the S&P 500. So then they write, okay, a daily. But when you do a synthetic write, normally like in a EOMax, you write it for a month on your synthetic. You buy a call, sell a put, and that mimics being long. Well, you can be long something just by buying a call. And then, sort of a bearish thing, you write a daily call. What's the purpose of the daily call? Just to collect income, right? You write the call. So they don't even hold it overnight, nor do they hold it over the weekend. So it's referred to as an intraday as opposed to, a weekly or something. And they're not using a full on synthetic. So let's go through the S&P 500. This one's performed better. I think part of that has to do with timing because a lot of you know that earlier part of the year up until the last month and a half, the money had really been flowing into the Magnificent Seven, into the NASDAQ 100, the biggest of the biggest tech companies. And now we're seeing a funneling, like I was saying, the undervalued nature in that thing is what about the other 493? What about the Russell 2000? So you're starting to see money pile into the secondary tech sector, saying, well, these guys are undervalued. We know Nvidia and Amazon and Tesla and Google and Apple, they all been getting the money, but what about tier two tech companies that are still large companies? They're just much smaller than the biggest guys, right? So they talk about it in here. What kind of yields? Well, when they make a payday, remember they pay once a week. They're collecting really on a daily basis, right? They can lose, but they're generally collecting money and then they pay out once a week. So you got to go through to do annualized and say, okay, what's the last payment? What's the current price of the fund? And multiply that payment times 52 times and divide it by the fund price at the time of the payment, which is once a week. And so your distribution rate and your yield, not your 30-day SE yield. You guys probably know that from YieldMax. That's your treasury money. Okay. So they're selling this one, the XDTE, as opposed to the 0DTE, or sorry, it's actually QDTE. The zero has more to do with there are no days, right? Days till expiration. So that's the nature of these funds. So they're XDTE and QDTE, Q being the NASDAQ 100. So we go through similar to other funds, 0.95%, right? You probably, I think yield max is 0.99, and on their funds of funds, they're 0.128. So you see assets under management, still fairly small, shares outstanding. Okay. And then their intraday trades, again, I have an example of one I'll show you, but that's just, they're posted and when the market's open to the market closes, because that's all that call is good for, right? They don't hold it overnight, 0 days to expiration. All right. So um, you see this on the last district. Well, this is actually saying as of 6:30, right? So the last time they did at 6:30, that's what they were yielding. And I have all that data and more for you. So they show you if you want to come in here and look, and I built my data from this, right? So you can see their pay date, right? They're typically pay quick, right? So here's your declaration. Then the next day is X date and record date. After May 28th, they're always the same day now, T+1. So your pay date, then if it's not a weekend in this gap, which can happen sometime, but most of the time it doesn't. You're only talking 1 day later. So they declare 2 days later, you get paid. They declare 2 days later, you get paid. They declare 2 days later, you get paid. Okay. So, and then here's your distributions, right? Now this one is your S&P 500. So I think that's what I wanted to show you here. There is kind of one more little thing. When you can go look at the prospectus, summary prospectus, the supplemental tax information, that typically gets involved if they actually have a return on capital going into their fiscal year end, and that gets treated differently for tax purposes as opposed to the majority of the payments. So I thought this was kind of cool, although for people that don't understand options, I think it still confuses you. And I get it. It would me if I didn't really understand them. Um, what they're showing is here's the stock price. What is a covered call? Well, a covered call is where you write something out a little bit from right at where it's currently at, hoping that you're going to pick up some gain. So let's say that's one, remember, these are daily. So let's say it's 1% above the money, in other words, where it's trading at, then if it goes up 2%, at 1%, you're capped, right? That's all the money you're going to make, and you get it taken away and you made the money, right? It's over. So it's no different than the capping on a yield max fund, except their shortest period of duration is a week. So it's still the same process. So somebody that wants to even look at some of that, that's okay. All right, let's get into what I consider the more important stuff. All right, because this is going to tell you a lot. Um, and what we see here is the XDTE and the QDTE, right? S&P 500 and the NASDAQ 100. So at inception, which was March 17th, they started both funds. Now, the good news is, remember what I said, the Russell 2000, if you look at it earlier this year, wasn't performing very well because the money was all going to the NASDAQ 100. So if I had a choice of these funds and I was buying one, I would, the old saying in hockey, you don't skate where the puck is, you skate to where it's going. Well, it's already going into the Russell 2000 and more so into the S&P 500 outside the Mag 7, right, which constitutes like 35% of the S&P 500, even though the numbers are 7 versus 493, right? So again, a lot of you guys talk about ROI and you talk about how the dividends end up paying for the fund. That's one way to look at things. I'm going to give you all the data, such as total return, right? What did you make on your dividend payments annualized? What did you make by holding the stock on an annualized basis? Therefore, when you add these two together, this tells you the total return. I can tell you right now, most people look at the NASDAQ 100 and say, oh, yeah, I want that guy. Its annualized dividend is 26.56. Yeah, look at it. It underperformed the S&P 500 because when you net out the two, okay. Again, everybody looks at this different, so I'll tell you how some people look at it. Some people look at it as an ROI. Okay, so this is the inception price. Again, not everybody bought. And by the way, I put in 1,000 here. It really doesn't matter what number you put. These returns are these returns. If you put $1,000,000 or you put $100, that's just, so I just stuck it in there. But you don't even have to know that, but I used it as an example. So so here's the math behind this. So the inception price was 52.46. What's the current price as of today, or July 19th, the last time the market traded? Well, it was 52.02. So what is that percentage wise? Well, it's less than 1% loss, right? You bought it at 52.46 and it's 52.02. So technically you lost 0.84 of 1%. How long did you own it? Well, I'm using this date till today. You owned it 137 days. So guys, you had, all right. So when you want to know what is that annualized, okay, well, it depends on what you want. Just on the investment in the fund itself, forget the dividends and payments, which is the whole part that you want to know about, but you still have to know that. You have, when you take that 0.84 and you multiply it by the fractional percentage of 137, which is 2.66 of 365 days. In other words, it's projecting that you're going to lose 0.84 every 137 days. You can agree or disagree, right? The only way you're going to know is when you hold it for 52 weeks and whatever your buy-in and whatever it's at the end, but it projects to 2.23. So the dividend part's easy. It had a 6.71 return. Where does that come from? Well, add up all of the dividends paid on the weekly basis, right? Which I have in the spreadsheet right here. So I can go through and I can look at all these. And then every time I get paid on a weekly basis, I have a formula that says I multiply that times 52 weeks and I divide it by the current stock price, right? And that tells me what kind of yield I'm getting, right? And you look at these payments, they're 13% one month and they're 34% another month, right? So you're going to get variance. And over here, since they pay weekly, rather than making this in a percentage, I could put another column. I just said, how did it do compared to the previous week? In other words, what's the fund price compared? I could have also put it over here, amount paid, and then said percentage up or down. I just simply said, how's the fund doing? Right? Again, you could line this up with 30 columns, highs and lows and midpoints and averages and median. But I just wanted to give you something to look at. And then obviously this is QDTE. And another simple one is to say, okay, this is the one that had the minus 0.84 of 1%. And sure enough, when I did the daily changes, okay, then I came down and it dropped only 0.25. And what did this one drop? 1.44. So you had different numbers now, and this fund is priced higher. It came out at a higher price, right? Its inception was at, of course, this is, I think, at the first week of payment, so it's beyond inception, but I can also go back to inception. And you can see, right? One is inception was 46, the other one was 52. So this guy lost 5 point, right? It went from 46.44 to 44.07. So it lost 5.1% in 137 days. So when you project that out for the year, you're going to see a 13.6. So this number looks big, right? The 26 annualized dividend yield. but look at the actual. So again, sometimes the numbers fool you, or you're chasing high yield only. Now I get it. I know that people like to look at this and they like to say, well, geez, I spent $46, but how soon can I get $46? Well, based on how they're paying out, a long time, right? 10 periods of this, right? Because the dividends are 463. That's pretty close. And that's 137 days. So one could figure that it's going to take 1,370 days, right? And then we could divide that. I'm not set up for my spreadsheet, but I would say that's a little greater than 4 years. Four times three is 1,200. Four times 65 is 240. So it's a little less than 4 years, maybe 3 years. But here's the issue. You want to be careful, because what if every year, okay, and that's saying, well, I own it free and clear. Now I'm going to get all this money, okay, over from now on. And the concept is good, right? Return on investment. I get $46 back. Well, what if my NAV just keeps on going down? If it says, oh, don't worry about the NAV, you own it outright free. Well, what if it's a $14 stock and it's yielding 26% annually? Your payments are going to be very minuscule. So, to some degree, you can ignore NAV reduction, but not entirely, guys. Small, this starts to get my attention. This doesn't bother me too much. Okay. That's why when I showed you the curve stuff in some funds compared to yield max, you got to take that into consideration. Again, for each his own. I'm not going to tell you how to think. There's a lot of people out there in YouTube land, and there's a lot of people out there in investing, and whether they're doing yield max or they're doing anything, have theories, right? I mean, you go all the way back to CPAs, and they have, retire with their 4% rule, and all of these things. I'm just saying, for you guys, think, right? Don't let somebody guide you. Don't let them override your thinking. Look at it all and make up your own mind, right? I'm open minded about a lot of this. And just like, you know, 137 days doesn't make 52 weeks, doesn't make 365 days, but that's what it's been trending, right? And nobody can say over the last 137 days the NASDAQ 100 hasn't done well, because it generally has. But maybe over the last 30 days it hasn't done very well in comparison. All right. So the only other thing, here's the distributions. I showed you all that. The final thing is, this is what they put out intraday. So if somebody wanted to track this, I don't know that I'm going to get down to that level and I might do a weekly, but there's no way anybody cares about a daily. What did they win? I mean, the amount of work we'd have to do on YouTube to produce all that is crazy for the return on our investment of views and all that kind of stuff. But I'm happy because you guys have asked to tell you about the funds and show you some more detail and let you make some decisions on your own about whether you want to be in. Now, when is this one coming? The word on the street is they file for it. Okay. Well, when you file for it with the SEC, you're talking about a 75-day window for you to respond. They may ask for something. They look at your prospectus. They ask you this question, you respond, but it almost always takes the full amount of time. And what's not known is sometimes the funds get approved, but they're not ready to launch it. I mean, you may submit, I think Granite and their Yield Boost and even Yieldmax in the past, they'll go out and apply for 18 funds. And, they launch what? Fiat. I think this coming week they're due for dips. Fiat was the inverse of coin. And then dips is the inverse of NVIDIA. So, they probably have been approved on others, but they're launching them as they feel like the timing they want to do it. because if they flooded the market with 10, they probably couldn't get enough investor money and have assets under management. They want those shares being bought. And if they throw a bunch of funds at once, they're not probably going to get the capital. Okay, guys, that's what I got for you. It's not investment advice. I'm not a financial advisor, but hopefully this helps you guys. I know you want it. So thanks. See ya. Bye for now.